Hello everyone. Welcome to this webinar on a very interesting concept about the forex derivative crisis that happened in India in the year 2007-2010. I'm sure in your experience you would have read a lot of articles about this derivative crisis. Let's try and understand what actually happened here. At first, let us have a look at the brief table of contents, and then we'll get into the detailed part of it. First, let us understand what the crisis actually was. Okay. Then we'll also look at the various market scenarios that led to the crisis, what the market actually was that led to this kind of a crisis in the forex derivatives. We'll also throw a lot of light on what were exactly the forex derivatives that were used. We will also have a look at the negative impact on corporate India because of the derivatives that were done. Also, some insight into the sweeping changes that the Reserve Bank did after the derivative crisis unfolded and corporates had incurred so much of losses. And finally, and most critically, what were the lessons that corporate India learned after the crisis? Okay, so let's going one by one. Okay. Now, the derivative crisis in India occurred between 2007 and 2010. Okay, what actually happened was a lot of exporters across the length and breadth of the country used long-term forex derivatives to hedge their foreign exchange risk. Now, the derivatives were designed in such a fashion that exporters could benefit from a strengthening rupee. Okay, so if rupee gained and dollar weakened, the exporters could benefit from the derivatives. But the flip side was that if rupee weakened and dollar gained, there was a huge risk involved. Okay, so the derivatives actually exposed exporters to large forex risk if rupee were to weaken. The exit options was a very extremely expensive option. Now, what happened regarding the loss? What really triggered the panic and the fiasco was actually when rupee started weakening, the corporates started losing a lot of money. And when rupee weakened substantially, there was a huge amount of defaults that happened from the corporate side because they just could not pay the derivative losses. It is estimated that corporates lost more than 90,000 crores over a period of 3 years. Let's dig deep and understand. But before that, let's understand what was the market scenario that led to the crisis. Okay. Between 2006 and 7, the dollar was weakening against all the currencies and rupee was gaining, predominantly after the aftermath of the subprime crisis. Exporters were losing a lot of their competitiveness because rupee was appreciating, and there was widespread fear in the market that rupee would continue to gain. Now, there was an India Shining Concept campaign run by BJP, and that attracted a lot of foreign investment inflows, dollar inflows into India, and rupee continued to appreciate. Most of the market participants, forex market experts, banks, suggested that dollar decline will continue and rupee will continue to appreciate. Now, to protect exporters from this fear psychosis of continuous rupee gain, banks were selling complex long-term derivatives. Okay, now let's look at the chart, and this will help us understand what the market scenario was that led to the crisis before the crisis. So if you look at the chart from quarter 2, quarter 3, 2006, dollar was continuously falling. Okay, you can see the falling chart. Okay, initially dollar weakened from 46 to 44, and then abruptly and suddenly rupee gained from 44 to 40. So there was a very swift movement of dollar INR between quarter 4 2006 to quarter 3 2007. There was, from 46 47, rupee gained to 40 41, a substantial 12-13% appreciation. During this period of quarter 4 2006 to quarter 3 2007, that exporters actually started taking these derivatives. Now, if you see the data released by RBI, we can very clearly see that in 2006 and in 2007, the forex derivative volumes were very low, and it shot up in 2008, and subsequently in 2009 and 2010, it came down again after this, the market witnessed so much of losses. Now let's try and understand what these forex derivatives are actually. You know, the first derivative that was widespread and a lot of exporters across the country did was something what we call as the strip options. Now, strip options are typically leverage options that are taken for every month for multiple months in the future. So they mature monthly. They usually have a monthly settlement, and a lot of corporates also had bi-monthly settlements. So these options were monthly options, and that is the reason why they are called strips, because they are done on monthly maturities, monthly settlements, and for multiple months in the future, 3 years, 4 years, 5 years in the future. The options were designed in such a fashion that they were zero cost and there was no upfront premium paid. Now, let's understand what happened after these options were taken. You know, on the left side, when dollar gained, rupee gained from 46 to 44, exporters started taking these options. And in the middle period, the green colored period, where dollar further weakened from 44 to 40, more and more companies started taking these strip options. All the companies that had taken before and were had earlier taken in the initial period, you know, they started making money when rupee was gaining. Okay, as I said before, these options were designed to protect exporters when rupee gained. So as and when the rupee was gaining in this green part, all the corporates who took these derivatives made money. Now the pain started in the red part, you know, after quarter two 2008, when rupee started weakening. Initially, rupee weakened from 40 to 42, 43. You know, now these options, these derivatives were turning gradually out of the money and the corporate started incurring small losses. Then suddenly in quarter three and quarter four, rupee weakened substantially from 42, 43 to 49.50. This is the period where the corporates started feeling the pain and the losses started to compile and compound. And there were widespread defaults. The losses were so large that the companies could not pay. And since they were contractual obligations, they had to pay. Okay. So more and more rupee weakening happened. These losses piled up and more corporates began to default. Now there was another derivative, which was very widely used at that point of time. That was predominantly what we call as the foreign currency loans. You know, a lot of companies took cheap foreign currency loans denominated in JPY, Japanese yen, or Swiss franc. Now, these currencies were chosen primarily because the interest rates of these currencies were very low. Okay, so the interest burden were very low. Obviously, since you're taking a foreign currency loan in yen and Swiss franc, you have a currency risk. So, what banks did was, in order to protect companies from this currency risk, there were options embedded into the foreign currency loans. And all these options were designed to be zero cost, which means they had certain knock-ins and knockouts, what we call as the KICOs, knock-ins and knockout. What does knock-in mean? A knock-in means that the option comes alive if a particular level is touched. And knockout is the reverse. It means that the option dies if a particular level is touched. Okay, again, slightly complex, difficult to comprehend, but that is what was done, and that was what was propagated by banks. So bottom line, you had foreign currency loans and Japanese yen and Swiss franc, currency risk protected by options, embedded options, but these options had knock-ins and knockouts, which means the protection ceased to exist if the knock-in knockout levels were hit. Now let's try and understand what actually happened after a lot of corporates in India took this kind of foreign currency loans. Now let's look at the JPY denominated loans. Okay, I will look at the CHF denominated loans in this next slide, but let's first understand JPY. On the shaded area, this was the period where the corporates actually started taking the loans. You know, dollar yen loans, and they were loans taken when dollar yen was around 110 yen to a dollar. Now, most loans were taken and hedged at these levels, between 108, 9, 10, 11, 12, on an average 110. And all these KICOs, knock-ins and knockouts, were kept in the range between 80 to 85. Now, sorry, very unlikely at that point of time that the currency is at around 110 and that a level of 80, 85 gets hit. Very unlikely, 25-30% away from the current markets. But that is what happened. Markets are markets. Anything and everything is possible in a financial market. In 2010 and 11, JPY gained substantially. Okay. And it even went to levels such as 78, 79 JPY to a dollar. Very easily breaking these 80, 85 kikos, knock-ins and knockouts. So what actually happened was, since the options were knocked out, the protection was lost, and the corporates had to repay JPY loans 20 to 25% more expensive. So whatever they gained on the interest rate part, they lost on the currency part. Very similar thing happened in CHF. CHF was taken at an average rate of 1.05, okay, dollar to a CHF, with Kikos at 0.80 and 0.84. Sorry. So in 2010, 2011, unfortunately, after these loans were taken, CHF gained substantially, just like JPY, and all these knock-ins and knockouts between 0.80 and 84 were hit, which typically ended that the corporates were paying CHF 20 to 25% more expensive. Again, all savings on interest completely taken over, eroded because of losses on the currency part. Okay, now actually both these derivatives, strip options as well as foreign currency loans with embedded options, entailed a huge amount of losses. Okay, initially because of the strip options, early part of 2008, later part of 2007, a lot of companies made money. Okay, but after rupee started weakening, they started losing money, and later on, when rupee weakened substantially, they lost a hell lot of money, and a lot of these companies did not have money to repay, and they started defaulting. So whatever initial gains were there, they were taken to pay the initial losses. But later on, when the losses compounded and compiled because of large-scale rupee weakening, they could not repay, and they started defaulting on their payments. So again, since these are contractual and binding obligations, bank had to put in a lot of litigations. Corporates counterfile litigations to them against the banks. A lot of these litigations went as high as the Supreme Court of India for against the banks for mis-selling and fraud. Multiple judiciary courts in India directed CBI to conduct an extensive inquiry of actually what happened. Okay, why the losses compounded to such levels. So it was a large-scale bloodbath and mayhem. Multiple large exporters, small exporters, medium exporters lost a lot of money because of the strip options. Initially made money when rupee gained, but later on lost money for multiple years when rupee weakened. And when it weakened substantially. Since they were leveraged, the risks and losses were 1.5 times or 2 times or 2.5 times the profits. So the losses were so large that they defaulted, and a lot of companies shut down. Banks had to enforce force majeure and take over the assets. Litigations, bloodbath across the world, across India, I mean. Now, after all this chaos happened, RBI made sweeping changes in the forex regulations in India. Most of these exotic options were completely banned by the RBI, and only simple vanilla derivatives were allowed. So, separately, a lot of these private banks, commercial banks were penalized by the RBI, and penalized heavily by the RBI for mis-selling derivatives to corporates, despite the fact that the corporates did not understand them better, or probably they could not understand it fully. RBI also set guidelines into who could actually do these kind of derivatives by setting limits such as minimum net worth. So you need to have a minimum net worth criteria. You need to satisfy that criteria to do any kind of such derivatives. Exporters could only hedge for the duration of the exposure and not for long maturities. Like they did in strip options, they did for 3 years, 4 years. They did not have any exposure, but they still hedged for such a long period of time. There was also regulation changes regarding what we call as the appropriateness and suitability of forex hedging options. Specifically, also, there had to be exit clauses defined in all the derivative contracts. There had to be scenario analysis explained in each and every derivative contract. So bottom line was, since it was such a large pain period in corporate India, RBI came and made sweeping changes, substantial changes in the laws, in the regulations of doing derivatives in India, predominantly to make sure that these kind of things do not happen in the future. Now, two very critical lessons learned from the crisis. The first lesson, very critical lesson, is we should do derivative contracts to hedge forex risk and not to speculate on the forex volatility. Okay, everyone wants to make money. You want to speculate and make money, do it separately, independently. Mixing exposure management, mixing risk management with speculation is sure shot to it's like sure shot to destruction. Second very critical point is do derivatives only when you fully understand them. The predominant premise that the litigations happened where because the companies were unaware of the risks involved. They were aware of the rewards involved, but they were not aware of the risks involved. They were not aware of the exit options. So do derivatives, fantastic, very good to do it, but understand the benefits, but at the same time, understand and recognize the risks involved. So that's it from my side. Very interesting period in the Indian Forex market, 2007 to 2010. Such a crisis happened and such dramatic regulations changed after that. Great period. So that's it from my side. Thank you so much for investing the time and watching this webinar. If you want to ask any questions, you are most welcome to write to me at ritesh.victor@myforexi.com. You can even reach out to me on the mobile numbers mentioned here. Okay, thank you so much and take care. Bye-bye.